Welcome back. To wrap up this topic, let's talk about valuation discounts in the context of private company valuation. We'll learn the discount for lack of control and the discount for lack of marketability. Let's jump right in. Before we start, let's clarify some of the confusion you might have regarding discounts and premiums. If you recall earlier where we talked about estimating required rate of return, we refer to terms like size premium and industry risk premium, which when applied will decrease the value of the stock. Yet in this lesson, we will learn discount on lack of control and discount on lack of marketability, which when applied will also decrease the value of the stock. So which is which? Why are some of these factors referred to as premiums while others are referred to as discounts? Well, the answer is quite simple. The value of an asset is the discounted value of its future cash flows. So when a premium is applied to the discount rate, the value of the stock decreases. And when a discount is applied directly on the stock value, its value obviously decreases. So in essence, when determining the effect of a premium or discount, be very clear on which side of the equation it is applied on. Before we dive into the valuation discounts, let us establish the foundations of stock value, which will be different for controlling shareholders versus minority shareholders. Obviously, value of equity will be lower for minority shareholders because they have less say in the investment and payout policies of the firm. The controlling shareholder, on the other hand, can significantly influence management decisions to favor them at the expense of minority shareholders. This disadvantage to the minority shareholders is especially pronounced in private firms, as the level of corporate governance may not be adequate to protect the interests of the minority shareholders. For example, a controlling shareholder may direct purchases to other businesses that he has an interest in, perhaps at uncompetitive prices. This reduces earnings of the firm, so minority shareholders get shortchanged. Because of the possibility of such unfair practices, the application of a discount for lack of control is particularly important in the valuation of private companies for minority shareholders. But first, it's important to determine if the discount is warranted. There are three aspects to consider: the valuation method, the benchmark transactions, and the subject. If you recall the guideline transactions method, the benchmark are the acquisition prices of entire companies, so the element of control is already priced in. So if our valuation subject is minority shareholders, the discount for lack of control should be applied. But if the valuation subject is a controlling shareholder, the DLOC should not be applied. On the other hand, under the guideline public company method, the benchmark transactions are market-based trades on comparable public companies, which typically are minority shareholders' trades. So if the valuation subject is also minority shareholders, the discount on lack of control should not be applied. Rather, if the valuation subject is a party seeking control, a control premium should be added, which is what we learned in the last lesson. For income-based approaches, the adjustments are typically made directly on the cash flows and/or discount rates than on the final valuation. So if controlling interest has already been modeled, the discount or premium for control should not be applied again. However, if we wish to determine the value to minority shareholders with the value to controlling shareholders as benchmark, the discount for lack of control should be applied. So we've answered the question on when the discount for lack of control should be applied. Another important aspect is to determine the appropriate amount of discount to apply. This can be very difficult due to lack of data and the many underlying factors. The alternative is to estimate it based on the control premium, which we learned in the lesson on market-based approach can be estimated based on studying the share price of a comparable company that was recently acquired. For example, if the acquisition price of a comparable public company was $130, while its share price before the acquisition was $100, we can infer that the control premium was 30%. So is the discount for lack of control simply 30% as well? Well, mathematically, this is not too accurate. You should be clear that the control premium is measured with the value to minority shareholders as the base, so if this value is $1 million, the value to the controlling shareholder would be $1.3 million. However, if we reverse the perspective, the value to the minority shareholder is not 30% lower. Rather, if you calculate, it's actually 23% lower. Thankfully, there is a faster way to calculate using this equation. Plug in control premium of 0.3, you also get 23%. Do be aware of the shortcoming of this approach of using past transactions of comparable public companies. Primarily, the factors that motivate an acquirer to pay a higher price can be vastly different. Such factors can include perceived synergies. Another interesting factor is the likelihood of a liquidity event, like an IPO or strategic sale of the company. If such events are likely, the controlling shareholders would be more conscious of proper corporate governance and faithful accounting. This would warrant a lower DLOC, as the minority shareholders have less worries of being disadvantaged. Besides the DLOC, another adjustment for value to minority shareholders is the discount for lack of marketability. This discount is to compensate minority shareholders for the lack of liquidity in the shares that they hold. Generally, if DLOC is applied, DLOM should also be applied. This is because, unlike the controlling shareholders who can decide if they want to sell their controlling stake at a premium, minority shareholders generally have to offer a substantial discount to sell their shares on their own. This is because there are few potential buyers of minority stakes in private companies. As with DLOC, DLOM is hard to quantify as there are several factors at play. In general, DLOM will be lower under the following circumstances. The firm is likely to get listed or put up for sale. Dividend payments are high and regular. Little or no restrictions on selling the stock. There is a greater pool of potential buyers, and less uncertainty in the value of the stock. To estimate the DLOM, an analyst can use the prices of comparable securities as proxies. That is, to compute the difference in price between shares that are marketable and shares that are not marketable. For example, the US SEC Rule 144 restricts the sale of shares acquired in a firm prior to its IPO. The price of such shares are compared to the price of the traded shares in the open market to determine the DLOM. Another approach is to compare the price of pre-IPO shares to the price of the same shares after IPO. However, one complication is that post-IPO firms are generally thought to have more certain cash flows and lower risk, so increase in price after IPO may not purely reflect changes in marketability. So just for illustration, if restricted shares of a public company are priced at $80, but the shares on the open market are $100, the DLOM can be estimated as 20%. Now let's test your math. Given DLOC is 30% and DLOM is 20%, what is the total discount in value of minority interests from controlling interests? Well, if you say it is 50%, it is incorrect. The discounts are multiplicative, not additive. For example, if the value to the controlling shareholder is $100, the value after DLOC is $70. Apply DLOM of 20% from $70, we get $56. So mathematically, the total discount is 44%, not 50%. Like for DLOC, there is a shortcut to calculate the total discount. Not that important to memorize this, as it is rather easy to compute using the sequential approach that we just went through. Let's conclude with an example. Maggie owns 30% of TP Garments, while her business partner, Abhishek, owns the remaining 70% of the private firm. The firm's total equity was recently valued at $10 million using the GTM valuation method. Abhishek has no intention of selling the firm. The control premium of the firm is estimated to be 25% and DLOM is 15%. Estimate the value of Maggie's stake in TP Garments. Pause the video now and work out your answer. And we're back. Let's first calculate the unadjusted value of Maggie's stake. 30% of $10 million is $3 million. We're told that the valuation was performed using the guideline transactions method, in which the control premium is already accounted for. We therefore need to eliminate this control premium with the DLOC, which is calculated using this formula. The DLOC is therefore 20%. The total discount is the multiplication of the DLOC and DLOM. This gives us 32%. The value of Maggie's stake after discounts is therefore $2.04 million. And that concludes this lesson on valuation discounts and this topic on private company valuation. Take a break and we'll see you again.